You've got interest-bearing bonds, non-interest-bearing bonds, you've got municipal bonds, you've got convertible bonds, you've got seniors, secured, unsecured, preferreds, you've got all the way up and down the capital structure. There are millions of these things out there. And to think that just 4 or 5 treasury companies are going to be the only ones that are going to offer all these things, that's delusional. One of the hardest things as a Bitcoiner is you finally understand it, why that network is so strong, how that decentralization is so important. It's hard to be patient enough for everybody else to catch up. You're sitting there at the dinner table, at Thanksgiving, and you're explaining this to your friends and family. And, part of it is that nobody's a hero in the hometown. What do you know that's any different? Not listening. That's just a good barometer to understand that the entire world is struggling to figure this out. Part of it is just because it's difficult to wrap your head around a system that is unlike any other system you've dealt with all your life.
Hey everybody, today on Treasury Orange, I'm talking with James Lavish. James manages the Bitcoin Opportunity Fund, a private investment fund focused on the Bitcoin space. James has managed private equity for 2 decades and was recently named to the board of directors of Strive, which now trades under the ticker ASST. James, welcome to the show.
Oh, I'm happy to be here, Tyler. Thank you for having me, and look forward to it. Thank you.
Great. So James, before we dig into why you think QT is a dead man walking, I'd like to talk about you recently joining the board of Strive. What attracted you to this Bitcoin treasury company, and what's so important about Strive's management team over there?
Yeah, most importantly, so just starting from the big picture, and to give all the proper disclosures. First of all, my hedge fund, the Bitcoin Opportunity Fund that I manage with David Foley, he and I were invested in Strive right off the bat. We did their private pipe, and we like what their their thesis is, and basically look, I can't say too much about the inside of the company. We're in the middle of a merger, as you know. We're buying Semler, so there's not too much I can say about it. But what I can say is we respect the management of their company. So we look as investors, just looking at all the landscape of all of the Bitcoin treasury companies. They're not all made the same. We have MicroStrategy who blazed the trail. Between Michael Saylor and his team over there, we saw them as understanding the capital markets in a way that traditional companies just weren't understanding in relation to Bitcoin. And the ability to, first of all, they came out of the gates and we're just buying Bitcoin, putting on the balance sheet. And then Michael and his team came up with an idea that was to use convertible arbitrage, use convertible bonds to arbitrage the capital markets by capturing the volatility in their stock. Like they're basically monetizing the volatility. And so that was, to us, that was a kind of a cutting edge and a realization for us that this management understands Bitcoin and how to capitalize on the opportunity of Bitcoin, as it's just such a nascent asset at this point in the capital markets. And so we made that one of our largest positions right off the bat. That was one of our core positions in our fund. And then as the market started to evolve, and Michael started realizing that it's not just, obviously it's not just Michael. He's got a whole team around him, and one of the keys to the way that they're investing is they realize that you can't just the market will only allow you to use stock and dilute your shareholders to a point, just to buy Bitcoin and put on the balance sheet. Now it has been a winning strategy, obviously, because as Bitcoin appreciates, you're getting more Bitcoin on the balance sheet. You're creating Bitcoin, but they got into what we realized was a challenge in the capital markets, and they came up with a strategy to start offering preferreds, and in ways that were not going to dilute shareholders. And they did all kinds of different ladders in them. And at the same time, you started getting new companies saying that we're going to do the same thing. We're going to come out. You had your MetaPlanets, and you had your Semlers, and you had some other companies that were coming out and saying we're going to do the same thing. And then you had a smattering of companies, and it was like it was a feeding frenzy, as you recall, and on your show here. But they weren't all created the same, and so at the fund we didn't invest in all of them. It just, to us, it wasn't it there were differences in management, there were differences in the approach, there were differences in the underlying companies. And one of the things that we saw with Strive is they had this asset management company already, and they understood the capital markets. And Matt Cole, I had a long conversation with him when I was speaking at a conference in Prague. I was giving a keynote out there and about the institutional adoption of Bitcoin, of all things. And we really came to understanding that we see eye to eye, but we have similar backgrounds and understand each other, but we come at it from kind of a different viewpoint, from our different experiences. And so, lo and behold, and sometime in the middle of the summer, he called me up and said, "Look, we need to expand the board. Would you be willing to join?" And I was both honored and excited, and I'm truly excited to be part of that team, because they are approaching this in a way that resonates with me and resonates with our fund. And so we trust the team, we trust their strategy. They have an underlying business. We understand what they're doing and how they're looking to capitalize on this, and really make it an opportunity for their shareholders, the ones who truly understand Bitcoin. And I think they've got a very long runway. So, boiling it all down, Tyler, to that landscape, there's MicroStrategy has obviously been the leader, and you've got these other companies who have joined along, but there's just a handful of them that we feel are extremely strong at this point. Now that could change, obviously. We've got some turmoil in the markets recently, and that has that's affected some of these companies, and it's affected the confidence in them, for the shareholders don't really understand what they're doing. So, but that's kind of the just a framework of how we approach it, and why I thought that joining Strive would be a positive thing, and I could help them drive that shareholder value, and drive that thesis of getting more Bitcoin in the hands of the shareholders, ultimately, in the way of a public company.
Yeah, that's really cool. We're really excited to see what Strive does in the coming months and years ahead. We profiled them on our channel, and we're really bullish on the team Matt has assembled. And given his background in fixed income, we think there's, like you said, like a lot of runway there, and a chance to really capitalize those markets on Bitcoin.
Yeah, I mean, and if you look at, the other board members, I feel like it's a really strong team. One of the key players that I heard was going to be joining at the same time is Sharish, and Sharish has been the treasurer of MicroStrategy. He truly understands not just capital markets and arbitrage and convertible arbitrage. I mean, he's done all this stuff, but he's implemented it there in this strategy at MicroStrategy. And so, to have that knowledge, to have that experience between him and Ben Workman, Pierre Rochard, Ovik Roy, I mean, like, you've got this smattering of truly, I believe, exceptional managers. And then the ones that I didn't know beforehand that I've met, like Logan Barron, who's the chief legal officer. He's a professor at Yale Law. I mean, Arshia, Ben Pham, these guys, they're really knowledgeable people in the space, and I feel like we've got that kind of team that can navigate the uncertainties that are going to be that we're gonna have to deal with in the next probably 12 to 18 months as Bitcoin has its goes through the cycle along with the liquidity, the overall liquidity of the entire not just the industry but the entire market. So it was really important to me, and again, like I said, I'm just honored to be part of that team.
Really cool. Matt, Ben, Jeff have talked about how Strive want to roll out perpetual preferreds, hopefully in this calendar year. I don't want to get you in trouble about, talking too much about the inner workings, but, when we look at what Strategy did in Sailor rolling out the capital stack and kind of shying away from the convertible bonds and moving to perpetual preferred, do you think that capital has come in as quickly as you expected, James, or has it been a bit of a slower walk to those preferreds? Is there an education piece that the capital markets kind of have to learn before they're investing in those products?
Well, not every company can do it, right? You have to have the balance sheet that would warrant it. You've got to have the banking relationships and the management team that can be trusted to do it. And that's not anything that's not disparaging any other company that hasn't done them or has tried to do them and hasn't been able to. There just takes a great amount of knowledge and experience in the markets to do these things. You don't just throw them at the market and hope for the best. And so, but with this management team and with their knowledge and with the balance sheet that we're putting together, I think we've got a very, very strong platform to do them. It does take time. We've got this merger that we're involved in. We just had our shareholders that are getting access to their stock that was issued in that pipe, and so there are things legally that we have to go through first and take those steps to do it. But I'm very confident and excited about it. I think that this is just one of those companies that will endure and be in that top tier of companies that are able to weather this storm. Now, we already have demonstrated that we've gone out and we're buying another company that was under 1 MNAV. For those who are listening, don't know what that is. Most of your listeners probably do, but for those who don't, what I'm talking about is the shareholder value, just the market capitalization of the company over the amount of Bitcoin that they own, the basically the balance sheet of Bitcoin. And so if your stock is trading under that, it means you're buying Bitcoin at a discount, basically. There will be companies that trade a discount here and there, and if they're not buying back their stock or they're struggling to either they have some debt on their balance sheet that they've got to sell Bitcoin to handle payments for or something like that, well, they're going to be ripe for being a target for a takeover. It's not really, it's not a negative thing. It'd be accretive likely to whoever buys them. And so it's a consolidation that's positive for everybody ultimately if that company has been struggling. But like I said, I think there's a very long runway here for these companies. At this point in this cycle, I don't think there are going to be thousands and thousands of them. Now, that said, as this industry matures, as Bitcoin matures, as the ultimate store of value, as it starts to take market share away from those other buckets. So right now, a lot of you have seen that chart from Croesus, right? Jesse Myers, who's got the total asset base of the entire globe. I used to do this chart years ago, and then Jesse he's keeping up with it very well. So he's been nice enough to let me use that everywhere. And I'm happy he's doing the work, and I don't have to dig into the BIS and all the other the IMF to figure out where all the capital is. But he does a great job with this. Anyways, so if there's $1 quadrillion of assets out there, that are investable assets, well, Bitcoin's been taking market share from, obviously, the first one that's obvious is gold. Everybody talks about Bitcoin being digital gold, but really, as the market is trying to understand Bitcoin, it's been considered a risk asset. And so it's been taking market share, if anything, from stocks. And so equities, and it's been considered a risk asset ever since its inception, and most likely due to just the extreme volatility of it. But again, as people who understand Bitcoin intimately and truly understand its value proposition and how it is ultimately the a better form of gold in digital form, um, then people will start understanding that it should be taking market share from other buckets, very large buckets, like the 300 plus $1 trillion real estate bucket, the 300 plus $1 trillion bond bucket. And so when you start thinking about Bitcoin taking away from that bond bucket, you can imagine how many instruments are out there that are offered that are in the form of different types of bonds. I mean, you've got interest-bearing bonds, non-interest-bearing bonds, you've got municipal bonds, you've got convertible bonds, you've got senior, secured, unsecured, preferreds. You've got there's all the way up and down the capital structure. There are millions of these things out there, and to think that just 4 or 5 treasury companies are going to be the only ones that are going to offer all these things, that's delusional. It's going to take time. I want to make this clear. One of the hardest things as a Bitcoiner is you finally understand it. You finally understand how it works and why why that network is so strong, how that decentralization is so important, and it secures the network. It's hard to be patient enough for everybody else to catch up. And you know that because you're sitting there at the dinner table, at Thanksgiving, and you're explaining this and to your friends and family. And, part of it is that nobody's a hero in the hometown. Everybody knows you. Like, what do you know? What do you know that's any different? And if they don't know that you really are truly, you're one of the people who truly understand this, and that other people around the world and investors look to you for information about this, they're not listening. They're just not listening. And it's not their fault. That's just a good barometer to understand that the entire world is struggling to figure this out. Part of it is because they get misinformation and intentional disinformation from the media, but part of it is just because it's difficult to wrap your head around a system that is unlike any other system you've dealt with all your life. And every single person that I know, that in my life who's been alive, has looked at the dollar, the U.S. dollar, as the ultimate store of value. Meaning they really do believe that that's where you keep your money if you want to hold it and not risk it. And to try to train their mind around inflation being insidious and stealing their hard-earned capital over years, and how 50% of it is gone after 10 years at best, if not a lot faster than that, like we saw in COVID. um, it's difficult to get their heads around that. So to bring this full circle to what the intention of this question and answer is, I think there will be thousands of different products and companies out there who are offering these things, but it's going to take time to get there. This industry has to mature. Bitcoin has to mature into that true store of value, where it's taking so much market share away from gold that institutional and money managers start to understand this is something that I need to allocate separately to, and I need to take some of my allocation out of the bond bucket to do that, because I'm really getting negative real yield on these bonds if you stop and look at the expansion of not just the money supply, but liquidity around the world. And to understand that, that's taking a lot of time, but people are coming around to it slowly. You're getting some important people understanding it. Even Ray Dalio said it. He said you should own a significant portion, 10 or 15% of your portfolio in Bitcoin and gold. He prefers gold, but he understands Bitcoin, and he mentioned it because it is coming around and separating from all of the noise that we hear of cryptos. It's truly separating from that, and the market's starting to understand and respect that.
That's well said, James. It's funny. I think a lot of the problem in communicating, the value proposition of Bitcoin is a lot of people don't think about money, especially in America, and how inflation is just insidiously chipping away at our purchasing power and devaluing you know um, the value of the dollar. It's funny. One of the reasons I'm really bullish on Bitcoin is I've gone into my daughter's school the last several years and had the opportunity to educate the students about the history of money, what money is,
That's
and
all.
Bitcoin's value prop. And who gets it the best is those kids, man. They're kind of like they've seen Bitcoin videos, they understand memes, better than adults do,
And they
and
haven't been brainwashed into thinking that, well, this is the way the world is. It's never going to change. Like the dollar is the dollar. It's always going to be the base currency. Not necessarily. Every base currency has failed. Every fiat currency has failed. But it's hard for people to wrap their head around that.
It is. I'd like to tag on one more point about the Bitcoin Treasury companies. So a lot of our viewers have been kind of frustrated with finding the correct entry point for some of these companies, like you kind of alluded to. And Michael Saylor said something. When you're early on a company like an Apple, like an Amazon, like a Facebook, you don't care if the stock's trading at $8, $10, $12 per share. And for Bitcoiners or people who are bullish Bitcoin treasury companies, I think we view those companies, kind of in the same light as those early big tech pioneers. We've seen the MNAV compression around these Bitcoin treasury companies. We're trying to educate people here at Treasury Orange, and we did warn our viewers that options markets were signaling that the prices could compress, around these pipe deals. What advice do you have as kind of an educational piece for maybe a retail investor or even institutional investors, who are bullish on treasury companies, like Strive, but are struggling to know maybe when a bottom is in or how to look at the long-term play of these companies?
Yeah. So what I would say is that, first of all, when you look at the Bitcoin treasury company, well, it there's two different sets of buyers, right? So you've got your institutional buyers, and one of the advantages we have as a hedge fund is that as an institutional buyer, we can buy in the private market before those shares come to market, and so we get them in the pipe deal. Now, people get all frustrated and angry about that, but the reality is we take quite a bit of risk with that, in that we buy these shares and we don't get them right away. I'm just now getting shares that I committed to in the spring, and of some of these companies. We're just now getting them. Um, so we had to mark our books all the way up, and we warned our investors, like, look, they're going to get marked back down when these shares come to market. Just know that this is just a paper market, like a paper mark. We have to do it for SEC compliance, but we understood that. But we did get the advantage of buying these things very close to or under one MNAV. And so that's one thing. So the second thing is, so if you're an investor in a fund like mine, then you have access to that through the fund. It's just what it is. That's one of the reasons that we do this and that we have this hedge fund, is to get access to things like that. I mean, not just for me, but for all of our investors. And so, but if you're an investor and you're at retail and you're not invested in a fund like this, and you just want to buy these companies, or try to time it, here's how I would approach it. I would look at the company, and first of all, I wouldn't look at the different websites that are listing the MNAV. I would go calculate that myself. How would I do that? Well, first of all, I would go and dig into the actual filings of the companies. Meaning, I would go to Edgar, I would pull up the latest filings, the latest 10Q, the latest 10K, or if there's an 8K or something out there that has an updated amount of shares that are out there because of something they've done. Look at that. Find the latest one. You can use AI to help you do this. You can use Grok or ChatGPT, or to help you read through these filings. Do that first. Figure that out. Then figure out how much debt is on the company. So you've got to add the debt in there and the cash and net those out. So you have your whole, and that's what we call the enterprise value of the company. So you have all your shares outstanding times the current share market price. plus all of your debt minus all of your cash, and that gets you to your enterprise value. That's the number that we use when we look at these companies. And then we take that over the Bitcoin that they own. So if they'll say they own, you know, if they own one Bitcoin, that's $110,000 worth. If they own, a million Bitcoin, that's $110 million worth. So you take that and you take your enterprise value and divide it by that, and that gets you what we consider a cleaner MNAV. Okay, that's number one. So get the right MNAV first. The second thing to do is look at what you think these MNAVs should be trading at. Well, if you think if you have a very strong company that is out there in the capital markets, has access to capital markets, has a strong management team, has a strong record of doing this, that you trust, that are going to continue doing this strategy that they claim they're going to do, like strategy, then you would probably give them a pretty good premium to that Bitcoin, underlying Bitcoin. So whether that's 1.5 to 2.5, whatever it is, that's up to you. Now, in my mind, but let's just put that out there for a second. Just hold that out there. And then if you see that you've got a company that's trading under MNAV, well, there's likely something either wrong or it's a short-term price dislocation. And that could be because you have all these shares that are coming to market from the private issuance prior to them being publicly listed or starting to buy their Bitcoin. And so their MNAV is being compressed by all those shares coming out of the market. You've got hedge funds and private investors who are dumping these things in the market, and they don't care. They got it at a better price. They're getting their profit, and they're getting out. So if that's the case, and you believe it's just a price dislocation, that it has a strong management, that there's not something structurally wrong, meaning that they're having problem meeting debt payments or something like that, they do have access to capital markets to continue this engine that they've claimed they're going to do, then if you're buying it under one MNAV, it's likely a good purchase, as long as you believe that Bitcoin's going to go higher from here. If Bitcoin goes higher from here, you're going to make money on that trade, very likely. And so if you're buying these companies, you probably should be believing that Bitcoin's going higher from here. That's like step number one. So then step number two is the MNAV. Then step number three is where is the MNAV trading in the market? So then with the best companies out there, the best treasury companies out there, what David and I look at is like, it's hard to wrap your institutional mind around this expansion and just how much accretion they can create in the markets from these things. And different companies will be able to do that at a different rate. However, a pretty strong kind of anchor for us to look at has been, well, what's a book value of a strong bank out there, and the book values of strong banks, they can get under one in a time of stress, but typically they're trading somewhere between 1 and 2, or 1.25 and 1.75. So we kind of look at like 1.5 MNAV. It's their book value. It's the book value of the shares. And we kind of look at that as that's a pretty good barometer. And so for a company like, for instance, MicroStrategy, if it's trading under 1.5 MNAV, to us, that's probably a pretty good deal. It's probably at a discount to what it should be trading at long term. Because if you consider MicroStrategy to ultimately be the JP Morgan of the Bitcoin finance world, then that's a pretty good spot. If it's trading under one NAV, like I said, it could be it's likely a target for a takeover. And if you believe that Bitcoin's going up from here, that's a pretty good spot. And then if you have other companies that you believe in, whether it's Strive Asset Management or CEP21 or some of the other ones, then if you see it under 1.5, you may feel like this is a really good deal. And some of those we do believe is a really good deal under 1.5. But that's us. That's how we look at it in our company. I hope that helps.
Yeah, that's very helpful. I can't disagree with anything you said. Um, so, James, I'd like to pivot and talk a little bit of macro. So, I think about a week ago, you published your article, Why QT is Dead, and QE is Coming. Can you walk us through what's happening in the plumbing of the financial system now?
Yeah, so I've talked about this for a while. I started talking about this back at the end of last year, early the beginning of this year. And what I was talking about, and it took longer than I expected for the reverse repo to be drained. But let me walk through what that is. So back in 2020, 2021 to 2022, when the Fed printed that $5 trillion, what happened was that excess capital that got into the system had to get parked somewhere. So it was on these banks' balance sheets through either investors, institutions, money markets, whatever. They have this a slush fund of $5 trillion that's out there, and they had to do something with it. And so what they did is they parked it in something that's called the reverse repo facility. And the reverse repo facility is it's kind of an open window at the Fed where you can take your cash, park it there overnight, and get a Treasury like return for that, meaning an overnight like return for that. And so what's significant about this is that these banks just sat there parked on all this cash, and they were parked they had all this cash they parked in the reverse repo. And so, well, we're running $2 trillion deficits, and Treasury the Treasury Secretary Janet Yellen realized, God, she screwed up. Everybody knows it. She didn't term out the debt. What do I mean by that? I mean that when they had the chance to issue longer term treasuries before the interest rates got jacked up by the Fed, she was Fed chair. I mean, she had been a Fed governor before. She understands this stuff, so she should have recognized it and anticipated. She didn't for whatever reason, which is why Bissent was hammering her during the election period. But what happened was she didn't term out the debt, meaning she didn't issue longer term debt when she had the chance to. And so, as you have this government that's now uh, just indebted, up to their eyeballs, the U.S. government and Congress who won't stop spending, and we've got $2 trillion deficits. Well, it's up to Treasury to facilitate that. How do they do that? Well, they issue bonds. The problem here is that we got to a point where we're paying $1 trillion of interest on bonds, on our debt, and so Janet Yellen recognized that he had all this money sitting there in these reverse repos. Instead of issuing longer term debt at 4 or 5%, she thought, okay, we're going to play chicken. We're going to play chicken with the Fed and with the economy, basically, and saying what we're going to do is we're going to issue T-bills, really short term debt, whether it's just whether it's 1 week or 1 month or less than a year. They're issuing these really short term treasury instruments. And by doing that, they were able to draw money out of those money markets. So when you have your money sitting at Fidelity, that gets parked in a money market fund, and the money market fund turns around and buys either the reverse repo or treasuries. And typically, they're staying at the short end of the curve, so they have a lot of liquidity there because they're not interest rate sensitive. The shorter term treasuries, the T bills. And so she realized that if she just offered T-bills at just a little bit better than the reverse repo, then they could start drawing money out of there because the money markets would be buying the T-bills instead. And that's what they did. And they did it for a couple of years. And it took a little bit longer than I expected it to take, but it's done now. They've completely drained the reverse repo facility. There's no money left in it. It's about $8 billion left, maybe $5 billion. I looked this morning. I mean, it's virtually nothing left in it. And so they took that $2.4 trillion that was parked there, they siphoned it out and put it into treasuries. Now what? Well, the next stop is really the bank reserves. And so as every single time that you do QT or you issue more treasuries, it's going to take money out of those bank reserves. And so the banks would use their cash to buy these treasuries. And so you're starting to see the bank reserve cash draw down. Okay. So here's where it gets interesting from the Fed perspective. So Fed Chairman Powell has indicated before in his press conferences and some of his statements that they start getting nervous. Like he's been saying all along, reserves are ample, reserves are ample, reserves are ample. In the last few weeks, you've been hearing some of the governors saying reserves may not be ample anymore. Why are they saying that? Well, there's a calculation that they do, and they look at, one of the main calculations is how much a percentage of GDP are the bank reserves. And if they fall below 10%, 10 or 11%, then that starts making the Fed nervous. Why? Well, because of the velocity of money, they need to have enough capital in the bank reserves to keep the system going. And as GDP goes up, it needs more capital. And so, with nominal GDP rising because of inflation, they need capital to have in the system. And if they don't have that capital in the system, well, it starts to break. Why does it break? Because as companies, institutions, firms, hedge funds, as they need dollars and can't get access to them, they have to pay a higher interest rate to that, and for that. And so it starts the interest rate for borrowing using treasuries as collateral. So if you're a hedge fund, then you need capital, for whatever reason, margin call, or you're doing something different, you need capital for an investment or something. You may take your treasuries and park them over at a JP Morgan, and then they'll give you what's called the SOFR rate, which is the secured overnight financing rate, SOFR. You give them the treasury, they give you cash, and you pay them an interest rate on that, annualized interest rate on that for a few days, whatever. You get your treasuries back. After that's done, you give them the interest rate they want on it, then all is done, right? Give them their cash back and the interest rate on that. Well, when the system starts getting stressed, the SOFR rate starts to rise. Okay, so now we're at a point, Tyler, where the bank reserves have fallen below 10%, and and you can hear the Fed governors, some of them starting to get nervous. Now they do have something that's called the standing repo facility, the SRF that they've created, that you can use that to get access to capital, but it's not open to everybody. It will help in very short-term times of stress. But if there's a growing stress for more and more dollars, it's not going to solve that problem. It will eventually still break. And meaning that you'll have that SOFR rate spike up, and that just grinds the financial system to a halt, because it prices people out of the access to capital. And so that's where we are now, where the reverse repo is gone. The bank reserves are down below 10% of GDP, and people are starting to get nervous, and the SOFR rate has been ticking up. Okay. And it does this, but it's been ticking up higher on that, on that intraday volatility. So why are we concerned about this? Where have we seen this before? Well, we saw it in 2019. We saw it in 2019 in September, before COVID happened. And what happened was the Fed was doing QT still from the great financial crisis. They were still trying to take the bonds that were on their books off their books, sell them to the market, which is quantitative tightening. And as they were doing that, and as companies made their tax payments, as foreign entities needed dollars because of interest rate exchange differentials, you had this tightening of dollars and this rise of demand for them, and they just weren't there. And so overnight, you saw rates spike. These SOFR rates, which were back then were LIBOR, you saw them spike overnight, and it priced everybody out. And basically the financial system was grinding to a halt in a matter of hours, and the Fed absolutely panicked. And what did they do? They stopped QT and they started QE immediately. So if you go back and look at the Fed balance sheet, you can pull it up on Fred, the St. Louis St. Louis Federal Reserve information portal. You can pull it up and you can see that the QT was happening, the Fed balance sheet was shrinking, and then right at the end of 2019, it starts going up again. And it looks like just a tiny little bit on that curve. It was a lot, but it started going up again. And this is in 2019, before the 2020 financial crisis of COVID and lockdowns, where they just then printed $5 trillion. But you could see this little bump that it was rising because they were doing QE immediately. I mean, it happened in a matter of hours. They were just like, boom, stop QT, start QE. We got to save the system, get more liquidity in there, because they were worried about it grinding to a halt. Again, because we have the standing repo facility, it may slow that down, but it's not going to solve the problem. So the question isn't when is QT stopping. The question is, or if it's going to stop. Its question is it going to stop now at this next Fed meeting, in the next week or so, or is it going to stop at the one after that? But I contend it's going to be stopping this year, and we're going to start QE pretty soon after that. They likely won't start QE unless we start seeing something like the SOFR rate really ticking up because of a need for dollars. If you see that the standing repo facilities start getting, instead of $3 billion or $8 billion, you start seeing 20, 50, $100 billion seeking capital overnight, the Fed's going to get very nervous. So that's just something to keep your eye on. That's what I'm keeping my eye on. But it's just a matter of time. It's not an if, it's a when do they start the QE again. And I think it's going to start pretty soon. If it doesn't start this year, it's going to be early next.
Yeah, that sounds extremely plausible. Before we dig into kind of the downstream effects of that, I do have a question about Yellen and her, not terming out the debt. That's a pretty well-known fact. Like you said, Treasury Secretary Scott Bessent was really harping on her during the election season. Was it that Yellen was playing politics so that the economy was more stimulated, or was she kind of greedy that long-term rates would continue to go down? Why do you think she made that decision?
She was stuck, and they were just playing chicken until they could get out of the situation where the Fed would start lowering rates. The inflation has been a lot stickier than they expected. Well, I mean, they printed $5 trillion. I mean, you don't have to be let's go to first principles here. More dollars chasing the same amount of goods equals higher price for goods. It's not that difficult to understand that. And so, but the inflation didn't come down quite as quickly as they thought it would, number one. Then the second thing that happened was right before the election, the Fed did lower rates by 50 basis points. Well, what happened to the long end of the curve? It spiked. It went up by 50 basis points. So you had a 1% differential of expectation there. And it spiked because people said, you're lowering rates right before the election. It's a political play. Whether or not it was political, I mean, it sure looks like it was, because then they held rates for another year. I mean, come on. So I don't know. But what you can say is that the bond market wasn't buying it. The bond investors, they demanded a higher rate on those longer term treasuries, the 10-year treasury and longer, because of possible inflation expectations, and just knowing that there's going to be a deluge of treasuries coming to the market. Even through DOGE, you saw they tried so hard to cut, and they did cut some ridiculous spending, but it made a tiny little dent in the budget. I mean, we're not going to balance the budget at this rate. It's just not mathematically possible with where we are structurally. And so we're going to continue running these deficits. We're going to continue needing to have the Treasury issuing more and more debt every year. But quite honestly, Tyler, I think that Bessent was surprised too. I think Bessent expected that they would come in, the market would kind of be rolling over. The Fed would be they would be lowering rates because of unemployment starting to spike up, because inflation coming down. But in reality, inflation has been stuck around 3%. Unemployment is ticking up, but it has not had that, gargantuan jump you see at the front end of a recession. And so Bissett himself is having to deal with it now. And they thought that it was all gonna be kind of laid up for them, but it hasn't been. And so now he's dealing with the same problem. And so they're coming up with ways to manage that. And but they're in a sticky spot now.
Yeah, yeah, it's really tough with the sticky inflation, and obviously these guys at the Treasury, the guys at the Fed aren't idiots, but they almost act like it, right? They pretend. Something he said reminded me of Powell during COVID. I remember he was being interviewed, I think, before Congress, and one of the I don't. I can't remember which senator it was, but probably Rand Paul. But he was asking Powell, does Congress need to stop this insane spending, this insane deficit spending that's going on? And he said, oh, we're independent. I don't advise Congress. That's Congress's choice. We're just focused on monetary policy. But you turn back to March of 2020, and what was Powell saying? He was saying we need stimulus. We need stimulus. So it's really funny to see these guys act as if sticky inflation is something that they didn't cheer on and that they're surprised is here.
Right. I mean, look, let's just again going back to first principles, the Treasury needs inflation, They need nominal GDP to go higher. They need that in order to help pay down the debt, meaning they're not going to pay it down. This $38 trillion is not going away. But they can slow down the expansion of it by having nominal dollars go up, a higher tax base nominally, and then paying off that maturing debt with cheaper dollars as we go into the future. That's just obvious. There's three things you can do to tackle the debt. One of them is austerity. Nobody wants to do that. Who wants to cut? I mean, we've got the government's been shut down here for um, you know weeks because nobody's willing to cut spending. And the Democrats want to spend more, and they want to spend trillions of dollars on illegal immigrants. It's just madness. So like nobody's going to cut spending. So that's number one. Number two, they could raise taxes. Well, we're seeing what happens in the UK and in Nordic countries that when you raise taxes, capital flees. It leaves the country. The other thing it does is that it puts a crimp on productivity, because if you're a company and you've got higher taxes, well, that leaves less money to reinvest in profitable or new business lines. And so, you end up having a less profitable company because the money's going to the government, which is not, really, it's not additive to the economy, really. Yeah, it makes jobs, but the efficiency is not there. And so, what happens is you wind up having a decreasing profitability, decreasing tax base, and you get to kind of the same number, except it's even worse because now you're having a decreasing profitability, and GDP will be decreasing rather than increasing. And so that's not good. The third thing they can do is just default. They can just default on the debt and say, we're going to give you X pennies on the dollar for it, and we're going to reset everything and start over again. Well, that would be a hard default. They're not going to do that. I mean, no country that issues debt in their own currency would do that. They'll rather do the fourth option, which is option 3B, which is a soft default. The soft default on the debt by having high inflation and debase the currency every single day, which is what we do. We debase the currency to have a soft default every day. And that's why you have the US debt that's no longer triple rated. The rating companies realize it, and they can't ignore it anymore. They have to say that debasement due to inflation and uncertainty in the congressional process means that there's a possibility that the U.S. defaults. I'm not saying has a hard default and trips up, doesn't make a payment, but has a soft default or has a momentary hard default, meaning that we have a budget battle that goes beyond the timeline or the a deadline for raising the debt ceiling or something, and then we wind up not paying interest on the debt for a few days. That's happened before. They'll make up for it. They always do. They'll make everybody whole, but that is sometimes a semi-catastrophic event for markets where you've got infighting in Congress They can't decide on a debt ceiling. They can't get a budget and they can't decide on a debt ceiling. You don't get the debt ceiling moved. They wind up tripping that. And then what happens? Well, of course, they're going to pay everybody their interest that's due. It'll accrue until it's paid. But you have companies out there, Tyler, that are relying on getting payment on maturing debt, and they have a collateral that's against that they need to use that payment for other things. And if the U.S. defaults on it, even momentarily, even just a day or two, it could be catastrophic for that company. So it does have knockoff effects that are not seen by everyday investors. So it does matter, and that's why these rating agencies have pulled down the ratings of U.S. debt. So that's a long answer and kind of winding it your question, but
That was really comprehensive, James, and it makes a lot of sense. I think a key component of this soft default, you're not going to hear Scott Bessent talk about a soft default, obviously, or the Fed, anyone at the Fed. But a key component that you hear the Trump administration talking about is that they're going to try to grow their way out of this. Um, how realistic is that? Like, can they have this sustained high inflation without just devolving into a debt spiral with the currency debasement? And what are the ways out of this long term? Is Bitcoin kind of one of those safety valves?
yeah, there is no way out. This is just the way it's going to be. We're going to continue to add debt to the pile. We could see, we could see something of a productivity miracle through AI. Now, what that does to GDP, it's difficult to say because how does it change the working base? Like how does it change what we're doing every day for people who are in jobs that will be changed or replaced, likely replaced by people who understand AI. Um, but there will be jobs that are it's highly condensed. Just think about all the different things you do with AI that you don't need a person for anymore. um, it's not quite there yet, but that's coming down the pipe. It's going to change the workforce. What that does to GDP is uncertain. It's possible though that you can look at different, you can play out different kind of, probabilities of what happens in the future. And there is a possibility that we have something of a productivity miracle where you have just a jump in GDP and rise in productivity from AI. Um, I still don't think that just solves the problem overnight, though. So what can they do? Well, you've heard Cynthia Lummis talk about this, the senator from Wyoming. She wants a Bitcoin reserve. I agree with her. I think that we should have a Bitcoin reserve in the U.S. where we buy Bitcoin, put in the balance sheet of the U.S. Treasury, and we instead of just having gold, we have Bitcoin. Well, as Bitcoin becomes more and more valuable, as more central banks want to hold it as a core asset, as a Treasury asset, then that's going to create the situation where the U.S. as possibly the largest holder of Bitcoin has the ability to either use that asset to pay down the debt, or use it in a creative way to loan out to pay off some of that debt, however you want to do it. But it's unclear how that could work. But it is clear that if they own what Cynthia Lummis wants us to own, 1 million Bitcoin, that could serve as a way to not just pay down the debt, but it could be it could be collateral for the underlying debt that we have, and it could secure the debt in a way that we used to secure debt with gold, and that's a possibility. So either way, it would strengthen the U.S. balance sheet. And so I hope they end up wind up passing that. It's winding its way through Congress now. She has the Bitcoin Act, which is the act that says that Bitcoin will be added to U.S. government balance sheet. They would buy 200,000 Bitcoin per year for 5 years to get 1 million Bitcoin. They would hold it. It's winding its way now through legislation. She's got co-sponsors, but it's got a long way to go. They've got to get it into committees. They've got to have comment periods. They've got to revise it and, go back on committee. It's going to, this is a gauntlet. It's got to run. I don't think it's just going to happen overnight. Hopefully it happens during Trump's term. We'll see. We'll see how it makes its way through.
Yeah, I'm really, really hopeful. I love what Cynthia Lummis is doing. Definitely with that bill. I think I'm a little bearish on it happening this term, at least before 2026. But I think as more lawmakers understand Bitcoin, I think it's inevitable, right? When we see what Bitcoin is doing to the equity market and, as you alluded to before, what it's going to do to the bond market, to the real estate markets, I think it's inevitable that a country like the U.S. is going to see what it can do to capitalize the nation's balance sheet. Just thinking too about what you said about a productivity miracle for AI. I think of a historical example in U.S. history is when we moved from a farming economy to an industrial economy. Obviously, there was some pain with the job transition, but for workers who became part of that initial industrial base, we just saw probably the biggest GDP growth in human history, really. So I hope that's what that can kind of turn into, James.
And that's my hope too. But if you have an economy like that, you will need a very, very fast and trustworthy payment system, and hopefully, Bitcoin can help serve that. Especially if you've got AI making and receiving payments by itself on its own. You probably don't want that happening on Swift. You probably want that happening on a trustless system like Bitcoin. So that's a use case for Bitcoin that I think is huge in the future.
Well said, James. This has been incredibly valuable. Where can people follow your work?
Yeah, so I'm on Twitter, just James Lavish on Twitter. I have my newsletter we talked about, The Informationist. That's you can find that at jameslavish.com. That's just there's a free version and a paid version. The free version you get one every month. The paid version you get one every week. And then of course I'm at the Bitcoin Opportunity Fund. And if you're an accredited investor and you're interested in that, you can just go to bitcoinopportunity.fund and give us your info. We're happy to jump on a call to see if it's something that would be appropriate for you, if it's right for you. And we're happy to talk through it. So
great, James. And one thing we have all our guests say before they leave is stay orange.
Stay orange, that's right.
All right, ladies and gentlemen, the man who is calling the liquidity crisis before Wall Street, James Lavish.